Hey everybody, welcome to your weekend review for the week of Monday, September 26, 2022. And oh, what a week it was. And it started off bloody on Monday. Bonds were down 2/3 of a point, 66 basis points to be exact, very early, with the 10-year being up 8 basis points. Waking up to that was not fun. But the only thing that was less fun than that was watching what happened throughout the rest of the day. Bonds had sold off in the overnight session as Europe markets, especially the UK, led the way. The proportion of the last few days has been smaller than normal. It's just that the 10-year yields are up more than 100 basis points in 4 days over in the United Kingdom. They have competing economic issues going on where they're wanting to cut taxes to stir the economy and help out from the energy crisis, but also trying to quell really high inflation. So those things kind of work against each other, so nobody really knows what the heck's going to happen. We also had some Fed speakers continue to reinforce hawkish messages despite recent volatility. The Federal Reserve is basically taking a chemotherapy approach to inflation where they say, damn it, we are going to kill inflation if we have to kill everything else on the way to it. This week, all eyes are on economic data looking for signs of weakness in the economy. We're actually hoping for some weakness in the economy because that's a sign that inflation is starting to calm down. Until we start to see serious signs the economy is slowing down, we're not even close to out of the woods on this. We get a 5-year auction on Wednesday. We get a 7-year auction on Thursday. We get the second quarter GDP number. Friday brings a big report, though. PCE inflation. The S&P ended Monday's session at its lowest level since 2020, since December of 2020. Things were not good then. And the Chicago Board of Options Exchange Volatility Index spiked past 30, which is as high as it's been since June. Like I said, we started the day down 66 basis points. We ended the day down 55 basis points. So that put us way below that floor of 97.422. On the 5-year, we're going to have to start looking at the 5.5, which is also below 99. So it's borderline even useless already. Things have sold off that hard. The high coupon TBAs are not very much in the money. Really, the only one in the money is the 6.5, which means that we're writing loans at 7.5. So there's probably going to be some money and some liquidity going into those coupons here really soon with the way things are going. Ugly doesn't even begin to describe the agency mortgage performance this month. Elevated volatility, highest in the last 5 years, and falling bond prices have banks sitting on their hands. Bid-ask spread, so this is basically where your hedge works. So the spreads between what you can buy and what you can sell securities at are wider than almost ever, which definitely hurts profitability of mortgage companies when they're buying the securities, or I guess selling the securities that go into the hedge. If we look at the 5 worst monthly returns this millennium, 2 of them have come this year, down -1% in July and -1.05% in April. That does not help things when volume is all the way down where it's at. After such a chaotic Monday, everybody was wondering how Tuesday was going to go. And Tuesday did not disappoint. Oh man, just when we thought we were going to get some positive news in the morning, stupid bonds went and ruined it. MBS were actually up 33 basis points on the bond market open, then quickly within like 2 hours went down to only being up 3 basis points. European Union and UK debt yields are leading the sell-off. 10-year yields are still down 3 basis points early in the day. We got durable good orders that came in at up 0.2% on a forecast of being down 0.4%. Core capital expenditures, this excludes defense and aircraft, was at 1.3 on a 0.2 forecast. Excluding the number of 1.3 versus 0.2 is arguably a big bad news for the bond market, or rather it should be. However, in practice, bonds haven't really paid a lot of attention to this, and it's just paying attention to a lot of other things. We also got Case-Shiller home price appreciation. Home prices fell 0.3% in July, though up 15.8% year over year, down from 18.1% in June. Still quite high, though it's coming down a little bit, will actually help those inflation numbers. Remember, home price appreciation is included in the inflation number, or at least market equivalent rents is. Most of the losses were actually in a couple of cities. So we had a couple of big cities that brought the average down. San Fran, Seattle, San Diego, LA, and Denver, that were all very expensive places to live, came down a little bit, and they brought the average down just because of their size and the changes. The FHFA fell by 0.6% month over month in July. This index looks at mortgages with conforming loan limits, so it's more centered around median price homes and ignored luxury and cash only transactions. New home sales rose 29% at a 685,000 annual pace, way higher than the 6% decline expected. These new home data is driving me nuts because we have terrible builder sentiment, but their sales rose 29%, but they're in the dumps. And then they're building houses, they're selling houses way faster than they can actually build them. There were 461,000 homes for sale at the end of August, but only 49,000, which is 10%, were completed. So median price is down 6%. So basically the home builders are whining about sentiment that it's too hard to make all those millions of dollars. I'm over it. Durable goods fell 0.2 in May, in month over month, like we talked about. July numbers were also revised downward. Excluding transportation, they rose. Capital expenditures increased as well. Consumer confidence came in at 108 versus a 104.5 forecast. New home sales, like we said, came in at 685 versus 500,000 forecast. The internal component of consumer of confidence data was strong as well. Easy for me to say. The data also hits. Fed's Bullard is reinforcing the same hawkish message. Everybody needs to get it through their head. They're just going to keep raising rates through the rest of the year until we get a recession next year. Just accept it and let's all move on. So after being flat and down for part of the day, I think at one point we were down 20 basis points, we ended up the day on a huge rally, probably just because everybody that had something to sell had already sold. So the prices got down to where people were like, hey, this is a bargain. I'm going to buy some. So in the last couple hours, we ended up being up 64 basis points on the day, which brings us to 97.19 on the 5.0. So that brings us just above this Fibonacci line at 97.02 and above that floor at 96.281. Hopefully it stays up here and it stays in this range and we can find a new normal range. So also rumors running amok the publicly held. Finance of America is selling its dedicated retail unit to guaranteed rate. We also got some great news here, or some great information from industry partner Rob Chrisman. So check him out at robchrisman.com. If you're not on his newsletter, why not? You're the only person that isn't. So he said some great stuff here. Why are rates going up? There's a lot of cash sitting in cash right now. Traders and investors are in no rush to deploy capital into riskier assets due to the grim economic outlet. But there's also no rush to place that capital into less risky MBS due to the Fed pushing rates higher. So they're just going to wait and buy at higher rates in a couple of months. When are rates going to go back down? Originators need to consider why they'd go back down or how. Supply and demand may shift, but if the Fed no longer is buying mortgage-backed securities or treasuries, which it's likely not doing, when there's a new pandemic recession, nobody wants it, that right? Kind of leaves us with rates coming back down when the inflation rate drops, and that's not predicted to happen until 2023. If you want some new information to pick your brain because you can't rely on interest rates to get you business, so you got to find it on your own and change your mind to do it, check out our blog at WellThatMakesSense.com. This one is from the Innovator's Paradox, which is all about resource allocation. To innovate, it's all about resource allocation. Thousands of decisions are made every day by hundreds of people. It's all about rationing out time and money. So learn how to do that in order to innovate in whatever you do. And then on Wednesday, we got a rare and elusive win for both the stock and the bond market. Craziness, I know it. UMBS were up 56 basis points real early. Even in the morning, the S&P was on the positive side of things, up like 4 points early on. But as the day went on, the wins just kept on coming, closing the day with the UMBS 5% up 89 basis points. So far, we've regained probably 3/4 of what we lost on Monday. And the S&P ended up being up 71 points as well. The 10-year Treasury down a whopping 22 basis points on the yield today. By far the biggest thing affecting the bond and stock market is fiscal announcements out of the United Kingdom. They announced they're going to drastically increase debt and an unfunded tax cut. Reading inflationary. Despite the deceptive bounce in MBS yesterday, the markets maintained in a tailspin of just a few hours into the morning until the Bank of England announced emergency bond buying. Again, inflationary, but at least it pushes back firmly against the supply-demand dynamic in the British bond market, which was carrying over into our market. Then Treasury yields spiked overnight on speculation the Bank of Japan would intervene to support the yen by selling treasuries. Regardless, global yields have been on a tear with the German Bund, still fun to say, now yielding 2.15%. Just over 6 months ago, that yield was negative. Throughout the day, we also got pending home sales, which slipped 2% and are down 24% on a year-over-year basis. That kind of sucks, but we need that in order to tame inflation. U.S. August advanced good trade deficit came in at $87.3 billion on an estimate of 89, so that's better than expected. This is down from $90.2 billion in prior months. Imports fell 1.7%, exports fell 0.9%. Most rate sheets aren't even given rebate pricing right now. Hopefully today's market moves will improve that. This is due to illiquidity in the higher MBS coupons. It's not the lenders trying to force the consumers to have some skin in the game to slow down refis later or anything like that. It's just the bond market's crazy because nobody wants to invest money now because they think they're going to get higher yields in the very near future with some more Fed rate hikes. Consumer confidence improved in August. Yay, this according to the conference board. These consumer confidence numbers are highly correlated to gasoline prices, so even though everything else is going bad, if gasoline's cheap, people tend to be happier about life. Uncertainty is very important right now. The Fed is relying on runoff from its portfolio of UMBS to shrink. With refinances out of the picture, normal purchase activity will have to do the job. That means people selling their houses, but there just aren't enough people selling the house, which means that the Fed might be pushed to sell off some of its portfolio directly into the market. When asked about it, Jerome Powell at the last press conference said that wasn't anything planned, though it is something that's on the table. But speaking about mortgage-backed securities, the mortgage REITs have been absolutely pummeled over the last week. AGNC Investment, which buys almost entirely agent securities, is down 17% over the last 5 days. Annaly, which did a reverse stock split, is down 16%. Wondering if margin calls are coming again in this space with all the volatility in the market. The one-year Treasury, which doesn't get talked about a lot, but is often held as the lowest risk security because basically the only reason it's going to default is if the entire U.S. government goes bankrupt in the next year. And then also it gets you your money back to reinvest at market rates in a year is just over 4%, which is quite high. After another 3/4 hike in November, it could push it up to 4.5%. On another not often quoted statistic, the Dow Jones Transportation Average, which tracks 20 large U.S. firms, including trucking, airlines, railroads, fell 12% month to date, double the decline of S&P. This will suggest that there's less need for goods, materials, and travel, unsurprisingly, given the higher rates. So hopefully this will help with that inflation number. Like we said, we ended the day being up 98 basis points at 98.08. So we're actually almost taking a run at the ceiling of 89.649. We're in the middle of this really wide range, which can cause a lot of bumpiness. With such a giant move in the U.S. 10-year Treasury yield being at 3.7390, down 22 basis points on the day. We're going to look at that graph a little bit. It made a run for that 4% mark, which hasn't been seen in a very, very long time. Fortunately, it retreated to end up being down at 3.749. So we're looking at a new ceiling on that of 3.785. So it's really close to that. But the next floor is all the way down at 3.5. So hopefully we can get back down around that level soon. And a great tidbit from Chris Maloney over at Bank of Oklahoma talked about inflation expectations. So if the theory of inflation targeting fears one thing above all, it's inflation expectations will get out of hand. Inflation expectations is a concept that believes that if people expect prices will rise, they will act accordingly and prices will rise. Two voting members of the Fed spoke Monday and were at pains to stress that inflation is too high. Price stability is first and foremost goal of monetary policy, and expectations must not become unmoored. But both Meester and Collins were also at pains to blame the elevated inflation on supply chain disruptions, the war in the Ukraine, labor markets. No mention of the 41% increase in monetary supply during QE4's active phase. I guess that had nothing to do with it, which is a little wrong. So while the Federal Reserve is unable to do anything about the supply chain or the issues in the Ukraine, it can reduce demand, which is a nice euphemism for creating unemployment. This is due to the belief that economic growth causes inflation, and slowing inflation requires slowing economic growth, which in turn necessitates higher unemployment. Long way of saying these moves are going to cause more unemployment, but then people have less money to buy stuff and inflation goes down. So everybody just needs to get on the game plan for that, unfortunately. And then the markets return to their loser ways on Thursday. This is why we can't have nice things. We have a couple of decent days and then got to give it back. MBS were down 61 basis points early and pretty much hung around that level all day. Yields were flat to slightly higher in Asia, but then sharply higher after record inflation. Record inflation. No. In Germany's biggest region, the UK continues to double down on fiscal policy that is sucky. We got a final reading of Q2 GDP is in, and it's negative, minus 0.6. In line with estimates, and same as the second reading, now we have officially 2 quarters of negative GDP following a negative 1.6 reading in the first quarter. The National Bureau of Economic Research hasn't officially declared it a recession yet, though. Since 1947, there have never been 2 consecutive quarters of negative GDP without there being an official recession. One of the things that's keeping them from declaring it official is the fact that jobs are holding strong. U.S. weekly jobless claims fell 16,193 on an estimate of 215,000. The 4-week moving average is 207,000. For the week ending September 24th, last week's claims were revised down to 209,000 from 213,000. Like we said, the second quarter GDP declined by 0.6 on the third revision. This is unchanged from the second revision. Personal consumption expenditures, part of that, was revised up from 1.5 to 2. The PCE index, which is inflation, was revised upward as well from 7.1 to 7.4. Construction and durable goods manufacturing were drags on the GDP. Home affordability is well below historical averages, according to analysis from Atom Data. The combination of rising prices and rising rates and home prices is a big driver. The bright spot is that incomes are rising as well. In fact, the proportion of national average wages required to support housing actually fell from 30.9 to 30% of income. At the end of the day, we were down 56 basis points on the 5.0 MBS. The 5.5 was down 53 basis points. So that UMBS 5.0 is right again testing that bottom mark. It looks like we're trying to test that again, ending the day at 97.52 on a floor of 97.02. Saw this graph earlier today on a webinar. I thought it was kind of interesting. We're showing the proportion of money spent on food for dining out versus groceries. The silver line is money spent dining out. Blue line is groceries. So you see in 2020 was really the only time it inverted. I had no idea that Americans spent that much more money dining out than on groceries. I guess I thought people cooked a little more than they do. We also got a post from our sponsor at WellThatMakesSense.com. Check it out. It's from the book Innovator's Dilemma: How to Be an Executive That Doesn't Get Wrecked by Innovation. One of the unique things about innovation coming into an industry is very smart people who are trying to do their job to maximize profit in their industry will often miss innovation. So it's good to learn how to not get wrecked by it. And Friday brought us more heartbreak. Why would we expect anything else out of the bond market at this point? MBS were up 25 basis points in the morning. We thought we were going to end the week well. Have a happy Friday. Then we got hotter than expected inflation numbers. Core PCE came in up 0.3 when it was expected to be down 0.1. Core PCE, which excludes energy and food, was up 0.6 based off of an estimate of being up 0.5. Core PCE annualized rate came in at 6.4%, which was up from 6.2 last month. Not a huge miss, however, it's not showing any signs that the Fed's moves have done anything yet, which means that there is more ammunition for them to keep cutting large at each of the next meetings. Also, there is the fear that there is a delayed response going on here, and then once the moves hit, it hits like a landslide and is uncontrollable in the other direction. Consumer sentiment decreased in September, according to the University of Michigan Consumer Sentiment Index. The survey apparently showed that people expect inflation to be 4.7% next year and 2.7% in the long run. Not exactly sure where folks are getting that number. Angel Oak also announced they're laying off 20% of their workforce and replace their CEO. Angel Oak is a big player in the non-QM world, which has seen a lot of troubles with securitizations and things like that, plus volumes down for everybody. Early Qs came in from overseas. PCE didn't really move things a ton. Late Qs were more position-driven. Traders were closing out their positions for end of month and end of quarter. Maybe a little bit of late trading off of that PCE miss. However, most of the PCE miss was factored in with the CPI number like 3 weeks ago. Even before the weakness, bonds rejected another opportunity to move below 3.72 on the Treasury, ended up the day at 3.829. MBSs were down 22 basis points on the day net. That's after being up 25 basis points early in the morning. So that's a 50 basis point move, which brings us right back down around that floor level at 97.02, which nobody really wants to see us go below on that 5.0. Next week is jobs week, so it will be a big one to see how jobs are being impacted by the moves by the Fed. It's kind of a weird thing here because we kind of need to see some bad numbers. It's tough to think about us, our friends, and our neighbors not having jobs or not being able to get jobs. However, that is one of the things that helps control inflation, unfortunately. So we'll see how that goes. So over the weekend, if you need some extra knowledge, some extra smarts, check out our sponsors and our influences, especially our sponsor at WellThatMakesSense.com. Have a great weekend, everybody.